Once more, 2025 was a year of extremes for Tesla, with its stock price hitting all-time highs on several occasions. For Tesla investors who had high expectations for the stock at the beginning of the year, this was particularly harsh. This time, investors are anticipating signs of growth in the value of the stocks this year. Fortunately for Tesla investors, there is a single catalyst that has the potential to push the stock up to 10 times higher in a single day. There's no reason why you would want to miss this one. Tesla has set the bar for electric car manufacturers and has presented its pivotal product for the last quarter of 2025. The automaker disclosed its last quarter earnings, which included $24.3 billion in revenue and $1.19 in profit for each division. According to Tesla, in the 3 months ending in 2025, automated revenue was over $21.3 billion, which included $324 million in net revenue related to the company's driver assist systems. In 2025, Tesla plans to transport around 1.8 million automobiles, a huge increase from this year. In comparison to 2025, the manufacturer claims that this indicates a development speed of almost 40%. According to its 50% annual development rate, Tesla stated that it plans to creation as quickly as possible. It also stated that this figure will help them stay on track with their long-term goal. What relevance does this have for Tesla? Let's sort things out. However, before we do, please remember to like, subscribe, and enable notifications if you enjoy this type of content so that we may continue with everything related to Tesla. Car sales are gradually skyrocketing, and this new goal can result in yet another success for the company. According to Tesla bull Dave Lee, 1.8 million vehicles sold this year would indicate a sustained annual growth for the automaker. The fact that Tesla is so close to doing this is exciting. Tesla transported 405,000 to 178 vehicles in the last quarter of 2022, which currently equates to over 1.6 million vehicles annually. Examining the creation rate yields a far larger figure of about 1.8 million cars. This is based on Tesla's production and delivery rates from the previous year. These figures are expected to rise in the upcoming quarters, since the automaker has not yet increased production at its factories. According to Musk, Tesla may potentially earn up to $2 million, but he has lowered these car numbers for precaution. Due to inappropriate circumstances, the Tesla CEO went on to discuss the automaker's interest, claiming that January saw the highest number of orders ever placed by Tesla automakers year to date. Orders have eventually surpassed production, Musk continued. So if this rate of production is maintained throughout the year, Tesla may actually ship more than 2 million cars in 2023. Undoubtedly, there is a need for Tesla automobiles, and this demand is expected to grow over the next several quarters. Tesla is also anticipated to meet this demand, with a notable expansion at its operations across the globe. Therefore, Tesla will continue to grow its development and revenue. If creation and request rates generally stay the same, which might actually raise the company's stock price, the fact that this is just one of the few catalysts for Tesla stock this year should not be overlooked. Renowned Tesla financial backer Cathie Wood believes that the company will see significant growth in the future. She estimates that the stock of Tesla may increase by around 5 times in the next 5 years, solely from electric automobiles. It's more like multiple times over the next 5 years for those who trust in independent vehicles. The chief continued, she is still optimistic about Tesla as a result. According to her, the company's shares might be purchased for several times the new price, or roughly $653.13, and then again for $1,699. It goes without saying that Tesla has a lot of work to go to reach this price after a brutal year. For innovative stocks, ordinary investors are no longer interested in buying the dip. Concerns that Musk's acquisition of Twitter will divert his attention and increase his deals of Tesla stock to keep the virtual entertainment company afloat. The rising loan fees that afflict development stocks and the emphasis that requests will be canceled in the event of a downturn have all contributed to the decline. Earlier in the year, development stocks, like as Tesla, suffered severe losses due to the Fed's multiple increases in financing charges in an effort to combat excessive expansion. The central bank raised its benchmark federal funds rate by 4.25 percentage points, the fastest rate hike since the mid-1980s. Additionally, Fed officials predicted that the rate would rise to a peak between 5 and 5.25%. One of the biggest declines on the index was Tesla, and the disruption caused by Musk's takeover of Twitter didn't help either. Tesla's dream appears to have come to an abrupt end, according to Epikos Karvaskaya, a senior specialist at Swiss Port Bank. According to her, investors are more interested in how the impending recession will affect Tesla, how competition from other manufacturers of electric vehicles will affect its market share, and when Elon Musk's Twitter projects would stop hurting the company. Last year, the Fed hiked interest rates several times. A more severe decline in assembly action has been noted in recent government data and corporate assessments. Rate increases by the central bank are intended to slow down expansion by lowering interest rates, and there is evidence that this is precisely what is taking place in the business sector. Nonetheless, there are indications that the Fed may decide to back a more restrained increase in financing costs, as officials are growing more confident that the economy is responding to their efforts to reduce expansion. According to recent reports, after gaining assurance that expansion will continue to reduce this year, U.S. central bank officials intend to slow financing and cost increases and debate how much higher to raise them. Fed officials stated in late open proclamations and meetings that slowing rate increases to a more typical quarter rate point would provide them more time to assess the impact of their current increments and determine when to stop. Additionally, Fed Vice Chair Lael Brainard stated that raising rates in smaller steps gives the company the ability to retain more data and likely better land at a sufficiently prohibitive level. Nevertheless, despite the significant challenges that Tesla has faced, the risks posed by Musk's Twitter diversion haven't been enough to deter the company's loyal supporters from purchasing the stock, which rose to prominence on Wall Street. During the pandemic, despite the ongoing decline in Tesla stock, retail investors continue to acquire more shares of the company due to the automobile organization's standard designs for the year. This makes sense. Furthermore, according to recent sources, concerns about an apparent decline in Tesla's interest may be fading. Additionally, it was mentioned that Tesla's alleged demand problem could work to their advantage. According to recent reports, Tesla is trying to use the overbuilding problem to maintain a share of the market, and the automaker's cost reductions and stored inventories pose a more urgent problem for competing new businesses. Tesla is currently facing the opposite problem from its competitors, and Elon Musk is assessing how he might be able to take advantage of it. The automobile industry has the potential to reduce automobile expenses while still reaping significant advantages from these vehicles. Interestingly, the EV Group is reportedly attempting to turn this test into a benefit while fighting with a swelling stock and softer requests for its automobiles in the United States, Europe, and China. Tesla has implemented a series of cost reductions for its most well-known automobiles. In the United States alone, Tesla may lose up to $7 billion in benefits this year as a result of its decision to offer its more popular automobiles with discounts of up to 20% below the original list price. However, analyses indicate that maintaining Tesla's position as the primary seller of electric vehicles is a long-term commitment. In the short term, Tesla might soon be losing out on advantages for a segment of the industry as a whole, but in the long run, it should gain a lot from fewer competition. From nearly 80% of the EV market in 2020 to 65% last year, the car company has recently lost market share to competitors. Therefore, this aggressive cost-cutting measure may be just what Tesla needs to get back to the top.